International and global businesses often deal with risks from changing currency exchange rates, which can affect their revenue, costs, and profits. To handle this, companies use currency hedging strategies that help reduce these risks and keep their financial performance steady. Currency hedging is important because it protects profit margins by avoiding losses due to unfavorable currency changes, makes financial forecasting more accurate by stabilizing cash flows, and helps businesses stay competitive by enabling consistent pricing across different markets. One common strategy is the use of forward contracts, where a company agrees to buy or sell currency at a fixed rate on a future date. This locks in exchange rates in advance and is easy to set up. For example, a U.S. exporter selling goods to Europe might use a forward contract to secure the euro to U.S. dollar rate for 6 months, ensuring their expected revenue doesn't get hurt by currency swings. The image of paper boats made from various currencies represents how companies navigate the complexities of international currency risks with these strategies. Futures contracts are standardized agreements traded on exchanges that offer transparency and liquidity, making them a popular choice for managing currency risk. For example, commodity exporters often use futures on the Chicago Mercantile Exchange to hedge their currency exposure. Options provide flexibility by giving the right, but not the obligation, to exchange currency at a set rate, helping companies protect themselves against losses while benefiting from favorable movements. A tech firm buying components from Japan might use US dollar to Japanese yen options to manage volatility. Natural hedging involves matching revenues and costs in the same currency, which requires no financial instruments. An example here would be a multinational corporation establishing local production in Europe to balance euro-denominated sales. Currency swaps involve exchanging principal and interest payments in different currencies, useful for long-term financing. A global bank might use these swaps to manage multi-year foreign currency debt. Dynamic hedging adjusts positions as market conditions change, allowing responsiveness to volatility, as seen in airlines that hedge fuel and currency exposure dynamically as prices fluctuate. In practice, large companies like Coca-Cola use forward contracts and natural hedging across numerous countries. Airbus actively hedges USD exposure to manage the currency mismatch between dollar sales and euro costs, and Apple uses options and swaps to protect its global product margins. Best practices include regularly assessing exposure, diversifying hedging instruments by combining forwards, options, and natural hedges, and integrating hedging strategies into the financial planning process to align with budgeting and forecasting cycles. Hedging comes with certain costs, including premiums for options and transaction fees, which businesses need to factor in. It also involves complexity, as managing these strategies requires expertise and ongoing monitoring to be effective. Another important consideration is the risk of overhedging, which can happen if the currency moves favorably and the business misses out on potential gains. Overall, currency hedging plays a crucial role in helping international businesses handle exchange rate volatility and protect their profits. By combining various financial tools with operational tactics, companies can stay resilient and adapt well in a constantly changing global market.